So in 2023, we put all 5 banks that went to 0 to 0. We are not big on consumer. Um, a lot of the reason why we're not big on consumer is the fintechs that got involved in it. So we believe the consumer non-recourse, non-guarantee loan is a ticking time bomb. I love the pundit that says, "Oh, of course, real estate's bottomed here," because it hasn't bottomed at all. And I think that from where these stocks are trading right now, in 2 or 3 years, I think they're absolutely, I mean, they're the NVIDIAs of bank.
Happy to be joined today by Brad Rinschler, founder and managing partner of Downrange Capital Management. Brad, great to see you. Welcome to Monetary Matters.
Thanks, Jack. Happy to be here.
Tell us, so you're a banks investor. What's your view on the banks right now as we stand here going into February?
So, view of the banks actually has changed a bit. If you followed us for a couple of years, performance in the fund's been really well, really good. But, we really kind of didn't like the bank setup kind of going to 22, 23. Um, so we were short a lot of the banks that kind of had some troubles and actually failed in 23. 24 was a great year for us. Kind of worked on both sides of it. Now we actually like banks here as setup, especially community banks. Um, Most of the portfolio is trading under book with significant, buybacks and pretty high dividends. Probably the average dividend in the fund is about 4 or 5%. Some as high as 8. So we actually like them going forward here. The new administration is, I say, going to be friendly to mergers in the community bank space, which has been really, really a headwind for the last 4 years. You haven't seen a lot of mergers, and a lot of them take 2 or 3 years sometimes to complete. So, um, kind of buyers were kind of gun shy about announcing deals. So we do like them going forward here. With the valuations right. And some of the names that are in the KRE or XLF are a little expensive. It's kind of not where we fish. We fish kind of smaller banks under 5 billion in assets, some on the OTC bulletin boards or on the NASDAQ.
So you've had a good performance in your fund, I know. Congratulations. So Brad, a lot. I'm looking at the big financials ETF. A lot of these are not even banks, like Berkshire Hathaway or Visa. But even if looking at a specific bank fund, J.P. Morgan, Goldman, Morgan Stanley, Wells Fargo, Bank of America, that's not really your sweet spot. Your strike zone is not even in the even more specific regional bank ETF like PNC or regional Regions Financial Corp, Citizens. You strike in the community bank world as well as the more mid cap bank world. Why do you like to swim in that pond as opposed to the larger world of the JP Morgans and the like?
Well, valuation's better, right? Probably more up to see mergers with premiums, easier balance sheets to kind of understand, our thoughts on it. And there's a lot less fishermen in those ponds, right? So valuations are right. They're true community banks, which we believe is like going to mirror the economies that they serve. Um, so, we're not, you could see us owning a Pennsylvania bank that's in, you know, 3 counties over, with 10 branches. That's kind of like what we'll look at. And like I said, when we look at like a Regions or PNC or an M&T, you know, one, you know, our model and Al's model is not going to really differ that much. Other than, and also, it's just hard to get visibility into the total company, right? The balance sheets are a little bit more construct. Um, Same with JP Morgan. I mean, someone asked me, JP Morgan's owners were good, so obviously good for the banks. Like, maybe not kind of where we play. So, it's what I've done for 25 years. We kind of live in a box and we don't really come out of it.
I like that. Brad, what is your history? How did you get into the box of small banks?
I actually just liked them. I mean, coming out of college, I liked them. Started a hedge fund. They kind of said, "Hey, pick a sector to kind of focus on." So I picked kind of the financials, and then kind of moved into the banks over time. Went to the sell side for a bunch of places. Um, Kind of bounced back and forth, and then in 2020 when COVID hit, and the banks got hit, partner and I just ran around and uh, launched the fund on July 1st of 2020. It's a pretty good time to do it. Banks were down about 50% on the year at that point.
And why were you negative in 22 and 23?
So the end of 22 started getting a little concerned here. We had an interest rate move here. Uh, we started to have an interest rate move that was going to be pretty impactful to, kind of the securities book, the loan marks, the interest rate marks. Uh, Analysts were saying they were just marks, right? They're just synthetic. They'll get them back over time. And we took a pretty hard stance that those marks are real, and we bet on it, and we were out very publicly talking about it. Um, because if backing into that capital, they just didn't have it. It's like, oh, well, we're going to get that back over 5, 6, 7 years. It's like, well, life can happen between now and then. Um, and the regulatory side of it kind of knew that. I think. I mean, there's all these, stress tests, shocks to the balance sheet, 100 basis points, 200 basis points. Like, oh, just do 300. Well, we had 500, so no one really knew the impacts of that balance sheet. It's just as bad. On top of that, before that, kind of all came to head, community banks are trading over 13 times forward earnings. And, one of our slogans, I mean, everyone's like, oh, buy the dip or, the Magnificent Seven, right? All these like kind of memes guys use to invest, which I kind of laugh at. But, I'll give you one. If you sell banks at 13 times forward earnings, you make money every time. So the setup was there, and then obviously there was something really fundamental um, that we saw, and we had arguments with the whole with the South Side. Is these weren't just marks, and we're still seeing that today.
So the Federal Reserve raised interest rates, shocked markets in 2022 and 2023 from 0 to 5.5%. Almost every bank, Brad, in their investor presentation will say, what happens to our earnings if interest rates go up? And almost every of them will say that they make money as interest rates go up because they're net income sensitive. But I think number one, that does not include at all the impact to the balance sheet, because when interest rates go up, their fixed rate loans, as well as their securities, regardless of whether they're available for sale or held for maturity, go down in value. And that's real. And you're saying that's real. And then also the liabilities, they pay a lot more on deposits. And when they go up so quickly, the cost of deposits can go up really quickly, and they can have a high deposit beta. Unlike like if it's a slow interest rate hike cycle, you can kind of banks can kind of sneak it in and not really raise rates that much, right?
Oh, I mean, the problem is that the U.S. Treasury came out with Treasury Direct, which means you can basically invest in Treasury yields, and the Treasury yields were better than a CD, and they have daily liquidity. You can sell whenever you want. So what you were seeing was that actually the Federal Reserve and Treasuries were actually a competitor of banks for deposits. So I mean, you could have let's say I was $100,000 in checking account. They could wire it out to Treasury Direct that day. CEO won't even know that they lost that money. They'll do that, times 100, and it doesn't take much for a bank to get in trouble. I mean, if 10% of deposits walked out in one day out of any bank in the country, it would be done, right? So, um, that's kind of what happened. So, on top of deposit pricing becoming a problem, there's also deposit flight that was going into U.S. Treasuries. Uh, and bank couldn't make a CD that made any sense because I could always just go get more yield than a Treasury, and I have daily liquidity, have it locked up. And that's what we saw. So it was kind of like a perfect storm. But the banks, it was interesting. The banks really didn't hedge much on their securities portfolio, and it kind of drives me nuts because if anyone, any bond desk could have saw this coming, I mean, they could have made their career here by just hedging out banks, you know, securities bonds. I mean, so we just have 6, 8, 10-year life in the securities book, and interest rates were zero. Like they only can go one way. So why aren't we protecting against upside? And then, a Fed chairman comes out and says, we're going to start raising rates. He gave us a 3-month head start before he actually started, and no one did anything about it. I mean, the impact was clear. It's just math. Um, and I just didn't understand why we couldn't had some. I mean, some guys did, but most didn't. I mean, FRC CEO is famous for beginning of 23 saying, somebody asked him about the interest rate risk on the balance sheet. He said, we don't hedge risk. We don't hedge interest rate risk. Okay, well, then fail. I mean, seriously, you got kind of stupid at that point. Um, but the impact was kind of upsetting to us. I mean, we would sit with banks like, yeah, well, we're going to get that back over 6 years. It's like, well, I have investors that need money, need to see returns now. You just took 25% of my tangible book away in tangible capital. I have a problem with that. So, plus these stocks got more expensive because book got hit. So, you think you own a bank at 125 a book, and then they report over a couple of quarters. And it's 150 book, stock hasn't moved. Well, stocks can go down from there. So, we saw that as an issue. We put all 5 banks in 2023 to zero, and we were early on all of them. And we were short Silicon Valley from
What do you mean?
$749.
Say that again.
So in 2023, we put all 5 banks that went to zero. We all have a little bit different kind of stories, but FRC, Silicon Valley. I mean, we shot Silicon Valley from $749. I mean, we didn't think it was going to fail at that point, but we saw some issues with Silicon Valley. Kind of all paths kind of led different ways, but a few had interest rate problems. First Republic, and then Republic First, if you believe that. FRBK. The CEO was funny because he actually put a press release out that said, I think investors are, compare us to First Republic. But we're really Republic First. I'm like, yeah, it doesn't have to do with the $4 billion hole in the balance sheet you have, right? So they both went to zero. Silvergate was interesting. But we took a really easy stance when the stock was in the 50s, right? They wire money to Alameda, blows the balance sheet up. CEO goes on TV, talk about everything but that wire, right? And if you didn't, all he has to do is answer that question. If we didn't do the wire, stock's going back to 100. Did do the wire, you're going to jail, and it's a fraud, right? And he would, so companies kind of blowing up, investors are calling employees, right? And he thinks it's the best use of his time to go on a weekly for a week, like a fireside media tour. I'm like, all right. And he's sitting there, and the only question he won't answer is this one question that it's all that matters. Doesn't matter anything else, but did he do the $8 billion, $9 billion wire from one commingling account to the other, knowing that was illegal? He won't answer that question. So that one, we took that stance. And then Signature was very similar. We thought we had Signature a bunch of different times. When a bank grows like that and totally goes in a different direction, it's very concerning. I mean, the group deposited balance sheet 30% in maybe 8 quarters. I mean, I don't remember exactly the specifics there, but we've been around commercial banks forever. And when Signature just tries to take a different path and go straight into crypto, we thought that was an issue. And then when CEO resigned and things were kind of blowing up, it was fairly obvious that this thing was going to get ugly. So, so those are the 5 that we put to zero. It was interesting first quarter of 23. I think the carry was down 40 and we were up somewhere around 30 or 40. It was wild. It was kind of like the Wild West. And then, 24 was a kind of a good year for banks, and not great. But we kind of led with a couple of larger positions that did really well. We had a few mergers come out of the portfolio, and we again third year in a row, we made money on the short side banks as well. So it was 24 was pretty good. I think 25 set up pretty good for if you invest in kind of small community banks. Most of them are trading under book. We don't really like kind of the setup on the overall market. So we think any type of pullback.
By overall market, you mean S&P or the overall financials?
S&P. I think S&P is, I also think kind of the political aspect of the market is interesting, right? So there's this euphoric move because we have a change in, kind of regime and policy. Um, Everyone is thinking that everything's going to be great. It's kind of the breadth of the market and breadth of kind of the economy. It's like, well, I don't know. It just seems like we started selling our banks in July after he got shot, right? So he takes an 80-20 lead in the polls, and the banks absolutely rip out of the building. Um, and there's this euphoric move. It's like, well, you think the polls in November and October are going to be 80-20? So we thought we faded that move. And I just think that the setup here for him is difficult. One, for to achieve everything that we think that he's going to be able to achieve, and then two, where the S&P is, how narrow the gainers versus decliners last year are in the S&P. It was like the narrowest ever. Um, Everyone's kind of bulled up in a few names. One today, obviously, they're coming out of pretty hard in NVIDIA. Um, so, we just think the overall S&P is a tough setup here.
Well, yeah, as we record the not
Yeah,
NVIDIA, 15%.
the meltdown continues.
Yeah. So Brad, well, I didn't know that you shorted all 5 of the banks that failed in 2023, or the big ones: Silicon Valley Bank, Silvergate, Signature, First Republic, um, and then Republic First. What was it? Just the rapid deposit growth as well as the huge amount of interest rate risk? Because to my knowledge, none of those banks failed because of credit risk. Well, I don't know about Republic First, but or Signature, but they failed because they just bought tons of stuff at 100 that went to $80 because the Fed raised rates, right?
Well, I mean, Signature. Let's just take Signature and Silvergate out. Those are just
Yeah.
crypto plays, and they were just a mess. So the other three, yeah. I mean, you know what? You know how far it is. I mean, you really have to be really talented to fail a bank without any credit losses. I mean, it's like I mean, seriously, you have to be talented to do that because it's very hard to do. I'm not quite sure that's happened in history, um, where there was no credit losses to fuel this. I mean, they just basically vaporized their balance sheets and their capital. Um, I mean, when FRC failed, I mean, it was no one wanted to talk about it, but I mean, they had a 15 billion negative capital stance.
Yeah, because
Tangible
of
book.
all the securities, they lost all the money on. They bought
Right,
securities when they bought the 10-year when the 10-year was at 1.5% at $100,
right.
and 10-year went to 5% or 4.2%, and it went to $85, and that lost them a lot of money. And the FRC is First Republic. I lost
Yeah,
money, Brad. I told you this, but I lost money buying First Republic preferred shares, which got paid out as 0.
yeah. It didn't matter. I mean, it was, yeah, that was a mess. Yeah, interest rate risk is crazy. Um, but listen, the Fed wasn't quick to start cutting rates, right? I mean, they raised 50 basis points in the midst of the march of when First Republic was failing. So, um, it was kind of an interesting time. Especially the 10-year keeps creeping back up there. That's a problem for the Fed's balance sheet. It's also a problem for banks' balance sheets.
Yeah, if the Fed was a commercial bank, it would be a problem for the Fed. Feds had tons of interest rate risk. Their balance sheet looks a lot like Silicon Valley Bank, but it's the central bank. They're not going to have any problems.
Right, right. They'll just buy more.
Yeah, yeah. Brad, what? So you're bullish on the setup now for commercial banks, for like smaller.
Community, community banks.
Obviously, you're bullish. You're bullish on what you like, or what you're long, and you're bearish on what you're short. Uh, what were the big themes in 2024? You said that last year wasn't that good year for banks. I thought it was. I thought the financial sector was up like 30%.
Larger banks were I think the KRX index was up 8 or 9.
Oh wow,
For
I
the
didn't know
last
that.
for the last 3 years, I think the KRX is down about 9. Um, the Russell's kind of flattish, and the fund was up almost 80 net. So, um, it's it the banks had an okay year at the end of the year.
Yeah.
Um, but they were down for most of the year. Um,
Yes, the smaller
so
banks didn't have that much good of a year.
right, I think the XL if you overlay the XLF and the KRX, I mean, the XLF is severely outperformed last 3 years. I mean,
Yeah,
these things have been left for dead. And then you saw it's kind of a move in the larger regionals. I mean, but some of the valuations like on regions and Truist, I mean, they just don't make any sense to us. Um, so when you look at our short portfolio, I mean, a lot of them is we have commercial office REITs. There's some West Coast office REITs just happen to happen in the portfolio, prior to the fires in LA. We have an LA office REIT in the portfolio on the short side. And a few like eclectic banks or payments companies, or I think we're short subprime auto lender, stuff like that. It's just kind of it's event by event. I mean, one thing we don't do in our portfolios, we don't just put like hedging on, as in terms of, oh, we're long State Street, so let's short some bank in New York. Like that's not what we do.
I like that.
Um, Everything has, we are in the weeds. Everything has a fundamental reason um, on why we're there.
Let's talk about the long side first. What's your biggest holding and why?
So big solid for the last, I don't know, 5 years has been GBank. This is GBFH. Um, I raised capital for these guys at the end of 19. I was sitting at Benny and Scattergood. We raised about $20 million for them. Uh, Honestly, I didn't really even understand or like the story when I first heard it. And just taking my trader to dinner, he's like, "You doing this GBank?" I'm like, "No, I don't really understand. It's a Las Vegas bank. There's some payments and patents, blah, blah, blah." And he's, "You got to take a look at this thing." So called him back up, kind of right around Christmas. I just was enamored by the story. So I called client of mine, friend of mine, Chuck Reed. I said, "You got to talk to this guy. Why do I need to talk to this guy?" "Well, just take 45 minutes. I don't need to invest in a $400 million bank, Brad." I said, "Take the 45 minutes." So by the time that call was over, he was on a flight to Vegas. He's the largest institutional holder. He was the largest person in that deal. But I called 3 or 4 other of my clients. I said, "Yeah, this is there's something here that's just insane." 2 of them did 4.9s. So then all of a sudden, the whole thing was raised. I raised the whole thing in 4 or 5 days. I think we raised like 18 or
I
20.
didn't know you raised the cap. Okay, so you've been involved with this for a big deal. So you know this company
Yeah, I
quite
mean,
well.
my mother owns it at $6.15. I mean, yeah, like this is, yeah, so that's when and I got to know them very well. At the time, it was a kind of a SBA lender, hotel lender. And they had this debit card that was for gambling. This, basically you sign up for the debit card, you know, um, at the casino, and then you have non-interest rate deposits, to fund that card at GBank. When they have protect you with the PCS patents, which you can look up online. CFPB friendly patents for pooled player. So like, let's just say, here's a problem right now. If you say, Jack, if you sell your Star Wars collection on eBay and you leave your money at PayPal gets hacked. Who's out the money? You are, right? Most people don't think that, right? Because you're leaving your money at PayPal. You don't know that that's not uninsured. And it's not FDIC insured, because PayPal probably banks at JP Morgan, and all that money is in one account, right? BCS patents allow you to break that out. It's individual accounts. That's how they got the Oregon State Lottery, right? They had this big lottery drawings, and like the, kind of something like the gaming tables and slot machine stuff is in that Oregon State Lottery. So they needed to figure out a way to track it, also to do, BSA, AML, and KYC stuff. GBank's the only one that could do this. So banks actually would have to license BCS patents to protect deposits here, because it breaks it down one more step so that everyone's got $250,000 um, insurance. So that's one thing that that's what they had at that time. it's totally evolved from there, right? So debit card's gone because the problem was that MasterCard and Visa um, kept denying like the gambling code. Bank of America didn't want you to do it. So it kind of like pushed them out. So they went to a credit card. So the credit card now is profitable. There's only 350 cards out there. It was just kind of like a pilot program, but it's already profitable. And the transaction volume is insane. People are actually using it's all super prime, right? I mean, 770 credit score. And I know that they're pretty strict because a buddy of mine who's a large investor at GBank um, applied for the card. He had like a 770 credit score and he gets denied once. So, um, so there's really no losses in it. And what we're seeing, I guess, the credit card is these people are using the card as like a marker at the table. So it's like, oh, they know me at Caesars. Mr. Rinschler's a $10,000 marker. Instead of getting that from the pit boss, you actually just hand your card and they'll put a marker on the card. And the next day, people are coming in, paying it off, or at the end of the month. So there's really no loss on the portfolio, but the credit card's already profitable with only 350 cards. So that's one way. And then they also just launched this, signed a contract, talked about it on the last call, with Konami for slot machines. So this is an app that are on the slot machines. That also has some marketing value for casinos to have on there. One thing about casinos, I didn't know this, but it's kind of prehistoric. Technology is totally prehistoric. And the one thing they couldn't figure out is they can't track the user or the player once he steps off the casino floor. So the Apple can kind of, because you have a GBank card, you put your card in as Mr. Rinschler, and you have $250 left in credit. Would you like to upload that now? Yes. I make 500. I make $500 in the slots. Immediately goes back into my GBank card, and I can walk over to the ATM and take it out. It's what says it's instant. It's not instant. Theirs is instant. You can get up and go take it right out. On top of that, the screen club would say, especially you've been here for an hour. Can we buy you, lunch over here at any dining center in the casinos? They can keep you inside. So it's a different way, for casino for marketing purposes, can track kind of where people go. No one knows where they go to dinner. You leave the Bellagio, where do you go, right? So, you work in strip. So like you can kind of keep some of that in house, which is great for the casino as well. So they have the slot machine app that now Konami is using. Now, what does that entail? Well, Konami is like 400,000 slot machines in the US. They have about 130,000, I think. So they're about a third. And every 1,000 slot machines is like 2.5 million in non-interest bearing deposits. So you can do the math on that, right? How many non-interest bearing deposits? I mean, there'll be so much non-interest bearing deposits that actually lend deposits out to other banks at prime plus 30. So I don't really know another bank that can grow non-interest bearing deposits like that. Also, they're not lending them out. So I can see them making a significant earnings per share just on lending deposits out they can't use, which is, we just talked about the deposit problem. These guys don't have that problem. So that's, another aspect of this, as well. I mean, it's been great. I mean, they raised capital again this year. We were a part of it. But now they don't need any capital. Company stated that, they'll file, to register for the SEC kind of, first of the year of this year, and upload in March to NASDAQ, upgrade to the NASDAQ in March. So they'll be eligible for the Russell. I mean, there's 14 million shares outstanding. Management owns about half of that. It's really tightly held for another 25%. So, Russell Fund is going to need to buy 1.3 million shares. And then maybe, 4 or 5 million shares out there kind of in public hands. I mean, there's some institutions that I guess could sell, but, it's going to be real hard to find some stock there, for the Russell guys, which is, going to be kind of interesting to watch the stock price here. But overall, I mean, I think that they can earn somewhere between, I mean, conservatively, I think they can earn somewhere around 2.25, 250 this year. Um, I think that'll double next year and probably double the year after. They've been doubling earnings every year. And there's a chance here for that my number looks absolutely stupid at the end of this year or next year, where, you know, 250 is higher than that. And I don't know what you put on it. I mean, if you look at kind of the competitors of that, whether it's cash or, I mean, any type of, kind of payments or fintech,
Cash. Yeah.
yeah, cash or CCB.
Yep,
I
yep.
think CCB is probably the best. I think that CCB and GBank will be the two leaders in fintech banks. And I think that from where these stocks are trading right now, in 2 or 3 years, I think they're absolutely, I mean, they're the NVIDIA's of bank. I think so.
Okay, so
I mean, I'm confident on CNCB. I'm very, very, very confident in GBank. So I think you can put 35 times on it. Let's just put 25 times on it. So, you have a 75, $80 stock this year, starts around 26 earnings for GBank, kind of end of this year, maybe, third, fourth quarter. I think $4 next year is, very, very easily achievable. So, I mean, that gives you $125. Um, yeah, I mean, I mean, the upside here is, you know, I think nothing like, if you have your bank hat on, you won't understand it. That's why a lot of bank funds just passed. I just can't, I don't understand it, Brad. I'm like, okay, well, just keep watching it. And then I still think that guys live in that box too. It's like, oh, well, it's not a thrift conversion. It's got all these other things. Uh, I mean, we think most fintech's garbage. I mean, we've been short a lot of it. But there's a few real deals, and CCB has it, and GBank has it. Um, I think I urge people to be on the conference call, or just pick up the phone and talk to management because, I mean, Ed's 82. I mean, it's Ed's baby. He looks like he's 60. Um,
yeah, I
you
didn't know
know,
he was 82.
yeah. I mean, he still flies a plane. He races antique sports cars on the track with a helmet on. I mean, works out 2 hours a day, which is, a lot more than I do. Um, but the path here is, it's now.
Wow, I had no idea this guy Edward Nairo was 82. Okay, so let's play back up. So you got your mother-in-law in it at
Yeah, I got everyone. We have everyone in it. Yeah, I
That's good.
mean,
That's great, Brad. I first heard about the stock when it was at probably about $20. It's now at $39.50. So this bank is up a tremendous amount. And as you hinted earlier, you don't lose money by selling banks at 13 forward earnings. Banks, unlike some stock, like if you buy Nvidia at a 30 price to earnings ratio, it just doubled its revenue despite current fears. Like banks don't grow like that. Banks don't grow like Microsoft. So often, and if they do grow like that, often there are problems. But so often it makes sense to pare down or sell banks when they rally like crazy, even up 30%. And GBFH was up last year. It was up
one,
well over 100%. I just I really don't understand GBank Financial Holdings. And, of course, I always urge my audience to, not get and make a financial decision if they don't understand the company. And I definitely do the same. I do know a little bit about some competitors. So there's as I didn't know about GBank before, but there's, let's say four main players in this space. Pathward Financial, you said earlier, Cash, Coastal, their CCB, and then also the Bancorp, and now GBank Financial Holdings. So I thought that the way that these are banking as a service banks, where basically correct me if what I miss is they uh do debit cards and they hold deposits for financial companies, fintech companies that are not banks. So the derogatory term for these is kind of rent a bank. So you have, a deposit, what you think is a deposit with a fintech company, but it's actually not a deposit. That fintech company has a deposit at, let's say, Coastal Financial Group, and that's an advantage because it's a non-interest bearing deposit, and every time there's a swipe on the debit card, they get high interchange fees. In what the Dodd Frank, it capped debit card fees. This is why credit cards have grown so much, way more than debit cards over the past 10, 15 years. But there's something called the Durbin Amendment, which means that if the total bank is $10 billion or less in size, the interchange fees on debit cards are not capped. So that's what I see the two advantages of like non-interest bearing deposits or ultra cheap deposits, and then you get the payment swiping. So GBank Financial Holdings, tell us where does this settle in on those two? Does it? You said it has non-interest bearing deposits. Does it also get interchange fees? And
Yeah.
is it making the loans for the credit cards? And then also, um, in terms of the results, like I haven't seen the growth yet. Like it is a lot in the future, right? Because I looked at the investor deck, and I think the the interest expense actually went up. I think.
Yeah, I mean, so the credit card is just turned profitable now, so it's been a drag last year. Um, First of all, as in terms of competitors, um, so the banking as a service is interesting, right?
Yeah.
Because when those are FDIC banks that you all listed. First of all, I don't think there's really a competitor in GBank because not on the gambling side.
Yep.
Secondly, when it comes to banking as a service, which is, I'll give you the Evolve situation. Evolve Bank failed because it's a, it was, um, it had a, I guess, cyber attack, had a breach and deposit flight. Um, but like that's a true banking as a service, right? They hosted all these fintechs, all the fintechs had their money there. Um, some of them actually failed the fintechs because they just lost all their money that was deposited at Evolve Bank.
Yeah.
I'll just tell you right now, if Evolve was licensing GBank's BCS, that would have never happened. That would have prevented that. And the CFPB understands that. It protects consumers, also protects that. So those are the banking as a service kind of payments companies that we're very skeptical. The three others that you mentioned, those FDIC insured banks, those are regulated. Um, Obviously, those are different than kind of what some of these fintechs are saying they're banking as a service. So, um, we like all of them. I mean, we don't own TBBK at this point. The Bancorp, we did. Um, and we like the guys at Meta or CASH.
Yeah.
Um, we just really never the valuation never got us into the stocks. Just kind of not the valuation where we want to start. And we own CCB. So, yeah, I mean, those four guys are kind of the only guys that do it really well. And if I'm thinking if I'm beginning one, I apologize, but there are a lot more companies trying to do this that either don't understand it or the fintech's just not there. There's going to be a lot more failures than there are success stories. And quite frankly, the four that you mentioned, I think either are or are going to be the success stories here.
Yeah, so full disclosure, I own Pathward Financial. The ticker is Cash. They used to be with MetaBank. They sold that license to Meta. So what about so now that I've disclosed my bias, people can understand. But what about Pathward? You said it was too cheap. I feel like at the time it was trading at an 8 price to earnings ratio. I'm looking at Coastal, which I do not own now, but I did own in the past. It has a PE of 28, probably on forward earnings. It's cheaper. And then GBFH, it's price to earnings ratio. I mean, you tell me, but I'm sure it's ridiculously high. So where what is it about Pathward Financial? Because it
Well, I
seems
mean,
expensive.
if GBank gonna, if I think GBank can own $4 next year on forward, right? Uh, Stock chase less than 10 times earnings.
Mhm.
Um, Coastal's kind of right there where, first of all, stock has had a huge
Yeah.
move.
Yeah.
Um, where we own it is not, our cost isn't here. So, I think Coastal's got this kind of EPS. When someone was throwing out a $6 or $7 number, for 26, I think. I mean, that's it's pretty good. Or $8. I forgot what, but someone was like, well, if they can get that, stock's going to be a double here. I mean, they all have kind of their own little pathways. They're all successful businesses. I mean, really, I do think that. And if you think fintech's not going away, and if you think payments companies, I mean, there'll probably have to be a lot of consolidation for payments companies. A lot of payments companies want to be banks. I mean, I know there's interest level there. I don't know how that would work, but you know, I think somehow these things have to become married. And it's either technology companies paying stupid amounts for banks, or banks folding in somehow licensing the fintech product. But uh, that's going to continue. And I think a lot of we call it fintech, but it's really like some type of CRM product, or just unproven fintech that banks are chasing. I think those are going to be, some of your problem children.
So do you expect just a massive growth in GBank's non-interest bearing deposits and uh, interchange fees? Like, how are they going to make $4 a share, or in next year? I
Oh,
guess
yeah,
this
I mean, wait,
is
listen, there's a bunch of, well, first of all, spread income on the gain on sale for SBA is, at one point it was in the mid teens, and it went all the way down to under 3. And now it's kind of back in the 5, 6, 7 range. So that'll grow there. But I mean, we know this for an SBA
yeah.
gain on sale. I mean, slot machines just taking off, credit card just taking off, um, all of that. Uh, and they also have state lottery business, which could be significant. Um, they spoke about, another state coming on board there. Uh, I mean, it's kind of all together. I mean, and again, I think these numbers are fairly conservative. I could see one or two or these things kind of taking off. Again, when we first got involved, it was kind of here's the bank's worth, here's the bank's worth now. Nice little bank. Then they have this moonshot of this fintech debit card. It's kind of one shot on goal. Like, you'll have an okay IRR if it just doesn't work. But there's this one shot on goal. Now there's like 7 or 8 shots on goal that these guys have created with CFPB and the licensing and all, like, slot machines, credit card, and all of that. So, and it'll have the potential to be an absolute, you know, serious game changer. Um, but even if they kind of just go with the 50% that they can do, as in terms of what this bank actually could achieve, um, I still think it's 5x up from here or more. So, um, I think that the numbers should be fairly conservative, but the opportunity here, I mean, listen, if I if I went to sleep right now, you woke me up kind of middle of 26 and said, "Hey, GBank's going to earn $10 a share in 27," I'd go back to sleep, right? I'll also say, if you said PayPal just bought GBank for $400 or $500, you know, this time next year, or I mean, I wouldn't be shocked either. I've had it for 5 years. It's kind
Yeah.
of all kind of come together. Some setbacks with like debit card, but you know, I'm just at this point, it's very exciting. And if anyone doesn't know the story, I urge you to talk to management or listen to the conference calls. Um, you know, I'm making my popcorn. I'm just watching the show here.
Well, you've done very well in the stock. The stock, definitely probably one of not the best performing bank stock last year. But Brad, I'm not talking to management now. I'm talking to you. Like, you've been involved in the name for 5 years. Like, where are the non-interest bearing deposits? Where is all this stuff? Like, other than the stock performance,
Well, I mean, they are. I mean, the balance sheet's grown what 300% in the last 3 years, so it's growing. I mean, it's growing actually bearing deposits. Um, I'm looking forward to seeing the quarter this week.
hmm
But as in terms of like with slot machines, like I said, they just got this thing kind of started, so that should come this year. I think what did he say? He got it for, I think, 25 million in non-interest-bearing deposits um this year for which I think will change, but that's my words. As in terms of for the just that's just for the slot machines. But yeah, you'll see. I mean, you'll see significant balance sheet growth this year, and earnings growth. Again, the company should continue to double earnings or somewhere around there. I think that that's very achievable and pretty easily beatable, um, over the next 2 or 3 years.
Thanks for telling us about GBank Financial Holdings. What are your other longs other than GBFH and CCB?
So I mean, we're in like a kind of a basket of kind of smaller names. They're kind of all small community banks that don't really trade very well. So, I mean, again, CCB is another name that we own. Um, Little thrift conversion, that's been really beat up, and FNWB, which is First Northwest, um, trades like 60% of book. It's past their 3 years. Management has not been disappointing. So, I think the stock, I think tangible looks somewhere around 18 and a half. I think the company has a pretty big buyback, which should be active in the buyback now, but um, it's not a sexy story, but I think the stock is worth more than book in a sale. I think actually they're turning it around a little bit. It was a little bit of credit, but just mismanagement and talk about fintech failing. I mean, they've chased a couple of shiny object fintech things that just didn't work out and were losses um, for shareholders. So
Oh, really? What did at first? I've never heard of First Northwest Bancorp, but what did they chase in terms of and was shiny object in terms of trying to be banking as a service or what?
no, it was a like a fintech mortgage, business line, which is kind of more like a CRO product. Again, um, valuation was stupid. It didn't. It just. I didn't think it was going to work, and it didn't work, and it was basically a donation. Which took the stock from 24, 25 to 10, um, along with a few credit blips, which they got past. Like I said, I think the company now, if you don't own it, it's either one, they're going to buy back stock. Two, um, I don't see a risk to the balance sheet, but it's, you know, they're either going to turn it around right now, the stock's going to work, or they're going to sell the bank and the stock's going to work. And management knows that. Um, I think other investors have been pretty frank with them. Um, that hey, this either works. We've arrived here. It's like this. You're going to turn this thing around now, or you're going to sell it because it's they're out of avenues here. I mean, the management's had plenty of time and plenty of chances to get this right, and um, it just happens to be that the stock has kind of arrived where I think there's a bunch of different ways that you'll win here, and I don't really see much downside.
And when you say there's not that much avenues, you mean the management's going to leave if they don't sell it or fix it?
The manager won't sell it. Won't leave. Then I mean, in my opinion, there's just two options. Either management performs here, and I'm talking about now. Like
Yeah, yeah.
looking for the fourth quarter number, it better be on the right side of par. Or and I'd skip maybe one or two more quarters here. Um, but I think there's some significant pressure on them to perform. And again, we've done well up in the Pacific Northwest. Um, last year we sold FFNW. We actually bought it late in the fourth quarter of 23, and in January sold to a credit union for $23 cash or 23.50 cash. I think we owned it at like 11 and a half. I mean, it's a similar story. I think credit union to buy these guys. I think there's plenty of buyers around book or slightly above book for this company. Again, good, good little company, great market, mismanaged. Um, and the price, kind of reflects that. So I think you can, uh, I think this would be if you ever want to own this thing, I think this is the time because I think there's a bunch of different ways you can win and not very many you can lose.
And it is a small bank, and I think a lot of that is not just the company, but it's also the regulatory environment that with uh Trump administration, it's going to be far more friendly to bank mergers, whether mainly the FDIC and again, I guess the OCC as well, and maybe the Federal Reserve.
Yeah, I mean, it's been tough. I mean, so I'll give you a few examples. We know a few board members um, uh, of banks that sold last year, and just kind of talking with the process. It's. I mean, if I told you the regulatory environment, regulator would walk in and say, your capital to risk weighted assets is too high, either raise capital now or sell. Oh, by the way, if you sell to an in market buyer, expect 2 to 3 years regulatory approval. But if you sell to an out of market buyer, expect 6 to 9 months. We don't want job loss. We don't want branch closings. So, first of all, you're sending banks a failure, right? I mean, if a bank feels like it should sell, it should just sell. If they don't feel like they have any capital, the stock doesn't, the stock doesn't warrant capital, or management is at the point, or the company's culture is at the point where it can't take the next step to become a bigger bank, right? It doesn't have any to offer, or it doesn't have the currency to buy a bank. It just feels like it needs to partner up. Um, Best thing for that bank to do is partner up, and probably the best buyers for that bank is an in-market buyer. One, they know the environment, they know the economies it serves, there's cost saves, and basically get two smaller banks that it's kind of 1 + 1 = 3. You get a stronger combined bank than you would a standalone basis. And saying you have to find or kind of put a gun to you, and you have to find an out of market buyer that doesn't know that that economy or that footprint, and the players in that footprint. It's kind of it's a hard task, and so current, deal metrics were lower because there's less cost saves, it's more risk. Um, and then if you did have a merger that was announced, you sat out there in 2 years with purgatory. Um, and I can't really figure out a reason why. A lot of these deals have closed now or approved, and just kind of, CEOs are kind of gagged, but like you start wondering if there's a problem, and there wasn't a problem. I mean, that's just kind of what it was. It was just they just left these things out there for. First of all, I know what they took away all of the power from the regional offices and brought it all to Washington, and then just sat on someone's desk in Washington.
For the FDIC.
Yeah, yeah, and it was made a lot of guys gun shy. I mean, it's just, why am I gonna do that now? Because the worst thing you can do is announce a deal for both companies and just sits out there, you know,
Without the deal closing because it needs the regulatory approval. Yeah.
right. By the time that closes or gets approved, everyone is flighted that's worth anything inside the bank that you're buying. God forbid it breaks, then you have two fractured banks that have cultures. One guy knows, well, you're working at one, they know that they're selling. The other one that was prepared for a merger. So people are leaving and kind of, I'm going to be, it's just cultures are totally messed up. And sometimes for 2 or 3 years, just doesn't work coming out of it. So, well, banks make this announcement, some of them, only a few, I think, been wrong, or, just tough deals. Like, why would you do that? But most of the time, these guys are announcing these deals, because it's the right thing to do. I mean, uh, for whatever the culture fit, but a lot of times it's the seller just kind of running that road, and you should never have a bank out there that's at a road, um, that feels like it's trapped, because, then they become problems.
Mhm. Brad, let's talk about on the short side. You said you've been shorting companies in the office space, or mortgage real estate investment trusts, companies that make commercial real estate loans. Yeah, talk to us about. I guess let's talk about ABR, Arbor Realty Trust. Why have you been short that name, and what? How's your thesis evolved?
Well, we're sure hot from higher. How's it evolved? Well, I mean, there's a Department of Justice, and an FBI investigation going on right now. So, kind of what we're concerned about, I guess Big Brother's concerned about that too. But I don't really. I mean, listen, I don't have to explain my thesis. Just look at their investor deck, and 98% of their loans are classified. He doesn't like to talk about that, but that's just the truth. Um, I mean, these guys had foreclosures. It's kind of not even cool to have foreclosures right now, like it was 10 years ago. But these guys have more foreclosures on. I think it's 6 or 7 in Houston. Recently, they had one in Atlanta. They're just, they're well, their LTVs are just through the roof. They bloated the balance sheet kind of late, in COVID when asset prices rallied significantly, especially in cities. Um, so I just, commercial real estate valuations is interesting right now because I love the pundit that says, "Oh, commercial real estate's bottomed here," because it hasn't bottomed at all. We haven't really seen any asset sales or significant ones. Um, but especially city office, some multifamily stuff like that as well, where they have a price on the books. I don't think the bid, if they went to sell some of it, um, is where they have a price on the books. That's our feeling. Um, and I don't know what the number is for like New York City multifamily. Is it appraisal value minus 10? Is it appraisal value minus 20, 30? I mean, some stuff that is sold in a fire sale has been 60 cents on the dollar, 65 cents on the dollar. Um, and I think that's the reason why Arbor's not sold any properties, because if they sold a few of them, the whole balance sheet would waterfall. Um, I think I just think the marks on where they have their assets marked is nowhere near what the actual values of them. And I think the loan to value doesn't give them any room. Um, so I think the LTVs, and they foreclosed on some properties. The LTVs, the one in Atlanta was a joke. They let the $25 million out in Atlanta, 22, and they foreclosed on it. You know, 18 months later, 22 months later. Saying the LTVs were at least 125. So they just shut it down. So I think they think that it auctioned off under 10 million a few months ago. But so I think there's more like that on that balance sheet. But you don't have to take my word for it, take theirs. No one really wants to talk about it, but 98% of the loans is classified in some way or another. And
And was classified, was I mean, like criticized by
yeah, criticized, or for one reason or another, it's not a pass loan. So either LTVs went too high, um, debt coverage is wrong, asset values come down, whatever that is, that classification, it's not a pass loan. It's criticized for one reason or another, um, or it's not performing. So, you know, until they can clean that up, which I don't think they really can, we'll kind of continue our thesis along that path.
and Brad, remind us, what does Arbor Realty do? They make loans to commercial real estate, but what kind of loans, and then how do they fund themselves?
Well, I mean, it's all a commercial mortgage, right? So, I mean, yeah, and they do some bridge loans, a short-term loan to get you from one place to the other, basically like bridge, right? Um, where they went wrong on the commercial real estate side is they made a big bet after asset prices ripped during COVID. If you look at that balance sheet, um, and why we like showing some REITs here is we just don't think that their credit culture is the same as banks. Um, so I'll give you a perfect example. One network, you know, New York Community Bank or Flagstar now, right? They have very similar loans on the balance sheet, and they're underwritten with LTVs at 60, 65, fairly conservative. Um, and Arbor's next door lending them at 80, 85. So look at all the problems commercial real estate and New York communities having,
Mhm.
because they were regulated FDIC entity, right? Um, and I think they're a stress bank. Maybe not yet. I think they're going to be a stress bank. Um, and Arbor doesn't have to deal with any of the type of regulatory issues. But if you look at the balance sheets, right? And listen, we've been negative on Flagstar for a very long time. Um, but Flagstar's balance sheet is so much more fortress-like than Arbor's. Because it's very similar loans, other than the fact that Arbor does the Sunbelt lending. Um, well, they've had a lot of foreclosures, in foreclosure in Nashville and I mean, 6 or 7 in Texas. I mean, these are inbound occupancy states, and they're still Atlanta. I mean, that's another one. I mean, it's like let's talk about the New York City commercial real estate, where you know U-Hauls are flying out of the state, but they're going into the states where Arbor's lending, and Arbor's still blowing up those projects. So like I said, that's an interesting one. We continue to kind of bet against management, and you know, again, they also have a Department of Justice and FBI investigation. So
What's that for?
hopefully, that asset prices and markings, and you know, there's been a few activist short sellers that have written on it about this. Um, so I urge people that if you are invested, just probably go read them. And if you're interested, I mean, I think that they put a pretty good case out there um, for that one, and kind of our findings are fairly similar. But again, you know, similar to the FRC story, we try not to get overly emotional about investments, but uh, this one's just math.
And let's talk about another company, the ticker of which is SAC8, Sachem Capital Corp. It's got a tiny market cap of $60 million. This, I believe, last time we spoke, you were short, and they are also a commercial real estate lender. And it's interesting because you hear so much about this commercial real estate doom loop, but then you look at the big banks or even the regional banks or even small banks, and I'm just not really seeing the carnage that was widely expected by pundits as well as professional real estate people. But I feel like it is in these tiny sort of tucked away names like Arbor or like Sachem Capital Corp or Sachem Capital Corp that, frankly, I'd never heard of Sachem Capital Corp before we spoke. That, oh, I'm like, oh yeah, here's the pain. Here is all of the carnage that had been widely expected.
That one, that one is, yeah, they have some problems there. We've been short that for a while. It's a fix and flip in a REIT structure, which you know we also have guys in the fix and flip business. For them to be in a REIT structure was already challenging. Um, Again, I know that just look at the losses on the balance sheet, and we've seen this before, and I just don't think they can survive. They have 7 or 8 baby bonds and preferreds out there that they're paying dividends on. Um, they basically had to they're basically burning the furniture to heat the home at this point. They just barely got the December funding. Bonds that were coming due paid. Managers said it themselves, they have no access to capital in the capital markets. They're blaming capital markets, but capital markets seem to be raising money for anyone and everything. So I'm going to bet against that. They also did a merger with a uh, Connecticut-based fix and flip. They also commercial real estate on the balance sheet. So I'd love to ask them about their office loan in the middle of Maine. That's has 10% occupancy, and it's on the books for 15 million, and I think it's worth probably $1.5 million or $2 million. So, yeah, that one I think continues to kind of take it along its path of, I don't see how managing to get out of this problem, but we'll see, right? That's what makes a market.
And then what about NEWT or New Tech One? What do they do, and why are you short?
So New Tech, I mean, New Tech's valuation's a little bit crazy. We don't trade in valuations. You know, we this is a BDC that bought a bank. Um, so they never had to deal with regulators. Um, we Yeah, it's interesting. These guys do called non-conforming SBA, where they're lending on
SBA is Small
non-conform.
Business Administration, yeah.
Right, but it's not conforming, so it's not government guaranteed. They also split that. They have a joint venture, an asset manager. Joint venture can um, decline any loan on an individual basis. So you could see, and then if they do decline it, Newt has to take 100% of that loan on the balance sheet. So if, if they can basically pick and choose the ones that are good and take half, or they can give it to Newton. Newt could take the whole thing. Um, they are going to have some credit problems. Management stated that they're not a credit culture. Management's, there's been some carousel in management. Um, we like to bet on drivers, not cars, and we just don't think the drivers of that bank is going to win the race. So, um, companies stated that yeah, we're going to try and outgrow credit. Well, that usually doesn't work. Um, so yeah, I think that one has some challenges in front of them, and I think that when they came out as a bank, I think they missed CEO's guidance. Really, really bullish, which was interesting, and they missed, I think, their first year by 50 or 70% their earnings. Probably 50. I think about 50. So, um, you know, I think management needs to prove themselves first, and I guess we'll see if they can do that.
Yeah, it's interesting. SBA, small business, I associate that as like government guaranteed loans, but then non-conforming loans, it's like it's not a it's not a government
Yeah,
guarantee.
he has a bunch of different like nicknames for things that, yeah, it's not conforming. So it is what it is.
Yeah, and then I'm just looking through investor deck of them. They compare themselves to Live Oak Bank Shares, which I believe is the largest SBA lender in America. What do you think about LOB?
We don't have a position in LB. If I wanted to get into that space, I would do a lot more work on Live Oak.
Yeah,
So, yeah.
got it. So when it comes to commercial real estate, uh, do you have any strong views on banks that are really into commercial real estate? I mean, the largest banks in it are JP Morgan, but JP Morgan's commercial real estate loans as a percentage of its total assets is very small. So I'm talking about banks like Wells Fargo or M&T Bank, uh, New York Community Bank, or now known as Flagstar. What do you think about banks? I guess Key Bank as well, Bank of the Ozarks. What do you think about any of these names I talked to? Any strong views?
So, well, I mean, I have a pretty good strong view on Flagstar, but Flagstar is kind of a victim of New York City politics, right? I mean, they changed the rent stabilized stuff to rent controlled. Um, Now, granted, it was a rule change in 2019. They knew that when all these loans reset, they were that the borrower was not going to be able to pay the bill, and they continued to put loans on balance sheet in front of that. When you straight so and they knew this was coming. So, um, you know, that's why they're dealing with those issues. They would be dealing with those issues as well, um, if they didn't grow the book, but they grew the book so significantly that it's not like it just couldn't work. It's not like it may work. It couldn't work. Yet there's other banks in that area, right? Like I think Stu over Dime did a lot better job kind of navigating this issue because it was a line in the sand, right? It was inevitable. It boggles my mind that this stuff happens because it's like, okay, here's the rule change. It's not going to change. Here's the impact on balance sheet. Let's do another 25% in between now and then. It's like, who made that decision? I don't know, but I wasn't in the boardroom. So, um, that one aside, it's kind of like a unique story. Um, Listen, we think commercial real estate, though, especially city commercial real estate, um, is challenged here a little bit. Um, especially when interest rates is high. It's just how to get things to cash flow is very, very hard. So there's only one way: either interest rates come down, then there'll be some transactions, or asset price has to come down, and there'll be some transactions. But for me to buy a building right now and get into cash flow at these interest rates, it's asset price minus 20, 30, 40. That's the only way. And again, this is math, right? That's why we haven't seen asset prices. We haven't seen asset sales, you know, in any type of significance. It's just one offs. This property has a problem. This property's a high value property that sells at 90 cents on the dollar. Like, we've seen those things, those pockets of these things. But for us to really get an understanding that maybe commercial real estate, like, we're out of the woods in the commercial real estate, like, you have to see some actual, puking going on of this
Yeah.
stuff at a price, and then we can kind of get a base price. But right now, it's kind of all over the place.
Yes, and what do you think about, Bank of the Ozarks, or I guess now it's known as Bank OZK? This is a very significant commercial real estate lender. Also, they do, what's it called? Construction loans, so unfinished buildings, which in my mind is should is riskier or should be riskier. They just reported, and, when I'm talking about this narrative of commercial real estate doom loop that you and I, Brad, have been hearing about for literally 3 years, I look at Bank OZK, a huge commercial real estate lender, and their non-accruals, their non-performing loans, their delinquencies are not significant at all. So, I think that it is. Would you agree with my characterization, or no?
So it's interesting. So a friend of mine brought me that, brought us to take a look at Bank of the Ozarks, kind of when there's nothing going on around the holidays. I have not looked at Bank of the Ozarks for 3, 4 years. For whatever reason, just again, well, the portfolio sets up right. 20 years I worked in the Northeast, kind of Pennsylvania, Mid Atlantic. So that's probably where our strongest relationships are, our strong understanding of banks. And then we kind of go across the country. But, you know, I would say the whole country is 100% of our portfolio, 40, 45% is kind of in these 6, 7 states. But we do like Bank of the Ozarks. We don't think there's a credit issue there. And we think the stock is very, very cheap. And and they put up a great quarter. The stock's been left for dead. Um, I do think that, he's a very good manager. Um, I think
George
they got a
Mason?
little, yeah, yeah. I mean, he was the best during, credit crisis, by far. His bank, again, with the size of that bank during 2008, 2010, it's a different bank now, but, um, he knows what he's doing. And I think that you can own the stock here. I do. We don't have a position. Um, that's my fault. We did a lot of the work. We didn't do all of the work. Um, and for our numbers to have a position, but yeah, I think stock actually does pretty well here. I think that if you bet on banks, I think you can bet on the Bank of the Ozarks and right ahead.
Interesting. And again, that theme of, like, it's not just does it have commercial real estate risk, it's, are they responsible? Do they have a strong credit culture? Uh, are the loans any good? What's the liability structure? That really depends. Okay. Brad, what about two, I would say, poster childs of the 2023 banking crisis, that they're too small to, be on the front page of the Wall Street Journal, and they didn't fail, but in terms of stock performance, price peak to trough, these definitely are. I'm sure you've heard of both of these. First Foundation, FFWM, as well as Home Street at HMST. These banks basically, I would say they had extremely high liability deposit beta, where their interest costs just exploded higher as interest rates went up. So they had to pay a lot more in interest expense, and then their net interest income went down, their net income went down. Strong view on these two banks, or just your general commentary?
Well, I mean, you can get me going home straight. If you follow me on Twitter, you know, um, okay, so both have the same characteristics. Um, we believe that it's very poor management. Um, Mr. Mason's already had a few failed banks in his career. Gets another one. Um, I kind of view it as like like if you get a cruise ship and you sink the cruise ship, you only get one boat, right? Where he's got a few boats. So, um,
At the bottom of the ocean. Yeah.
yeah, yeah. I mean, if I'm a captain of a boat and it sinks, I probably shouldn't get another one, but he did. That one's interesting though. I mean, we've been short that, we've been long that, we were just long that. Um, They had a busted merger. Um, I think the challenge of that bank again when interest rate risk is there. Um, but they have something on their balance sheet called a Fannie Mae dust license, which is there's only 25 of them in the world, 27 of them now. So you have to buy. It's worth a. At one point when we bought the stock, it was worth more than the market cap of the company. I think they could
What's it
sell
called? A
that
Fannie
thing.
what? Fannie what?
Fannie Mae dust license, DUS. Um,
Okay. I've never heard of that.
yeah.
What is that?
So Arbor has one as well, actually. If you
Oh,
believe
hey.
that. So only big banks have it, but some of the big banks don't, and they want it. Or Citizens doesn't have it. Um, who else doesn't have it? I believe Bank of America doesn't have it.
It's interesting. And yeah, First Citizens is literally 100 times bigger in terms of market cap than Home
Yeah.
Street. Bank of America must be thousands of times bigger. Yeah.
So Home Street doesn't even do any dust licensing because they don't have the capital to do it anymore. But um, they are they could sell that for a significant. Well, let me get you the dust levels right now. So like dust levels, so Arbor's one, Capital One, C. Richard Ellis, City, uh, Home Street, JLL, JP Morgan, KeyBank, M&T, NCB, PNC Regions, Wells Fargo. So Truist doesn't have one. So a lot of big banks that don't have these. And again, they're not making any new ones. So yeah, so it's a multifamily product that Fannie Mae has. Um, it's been, I mean, decades. This has been there, and they distributed one. The only way you can get one, is through acquisition. So some of these other guys have done that, but a lot of
Okay.
large off, a lot of REITs, large REITs don't have an asset managers off this thing. Um, so hopefully it has that. As in terms of FFWM, we don't have a position in it. They did recap the bank. Um, and I think the bank will be fine going forward. I just don't see a ton of upside there.
Got it. Brad, what are some other bank names where you've got strong views on them?
We like some banks in New Jersey here. Um, I think ConnectOne's interesting. You know, they get into Long Island. They bought First National Bank of Long Island, which is, I don't know, probably a storied franchise. And they paid 70 cents on the dollar for it, which is shocking because stock could have sold 3-4 years ago at 180 a book. Talking about interest rate problems. Um, those guys did it. I mean, that is, Long Island's one of the hottest markets in the country that no one knows about, but there's no community banks left. When I started in this business, probably was 12 community banks just on Long Island. They've all sold to regionals. And Flick was the last one, kind of like a dying breed. So, Connect One's going to get out to Long Island. I think Frank will do great there. Um, I think that one is very interesting.
Yeah.
So New Jersey is interesting, is prominent. We can't own that because my partner's uh, father is the CEO, but we've always bet on Tony when we could. And Tony just closed a kind of a real large deal in
Is this
Lakeland,
PBBC or PFS?
PFS.
PFS. Got
Uh,
it.
and I think Tony will be one of the leaders here in the Northeast. He bought a great bank for a very good price. Again, when you talk about mergers being out there, and that one's sat out there for 2.5 years, maybe even a little longer. So he's finally got it rolled up, and we love Lakeland and we love Providence. So them together with Mr. Labazette at the helm, we think that stock's very cheap. But again, we don't. That's just my feeling on it.
Got it. And do you do any investing long or short in non-bank asset managers, such as the giant alternative asset management, or financial companies that are attached to banks that do a lot of asset management as well?
We do. we just don't have anything in the portfolio right now. But we'll look at BlackRock, we'll look at Blackstone, Ares,
Mhm.
you name it, we'll look at it. There's been such an inflows of AUM into those companies that there's been really no reason to look on the short side. I think their day will come, but no, we monitor them and we monitor all the financials. Again, 95% what goes in the portfolio on the long side is community banks. Um, probably under 10 billion with sweet spot under 5. Um, and then the short side can be kind of anything we see the correlation in the absolute guts of these companies, not that they say bank on them, right?
Mhm.
So if commercial, you know, if commercial office is a problem, right? Okay, banks that have real commercial office problems, will have issues. Large parts of the portfolio is office will have issues, just like commercial REIT. The only thing is I think that the REITs actually don't underwrite as good. This capital structure is not as good. They pay out more in dividends, and there's less capital on the balance sheet. So, and their LTV is a little different. So again, so that's kind of where we're at. Um, the way we view the world. And the portfolio kind of runs net long
Mhm.
because short side moves around a lot more than it does the long side. So it's been great to own really cheap banks. We'll lose 2 or 3 or 4 a year in M&A. They're buying back stock, so we can always sell stock to the company if we need to. Well, probably 80% of the portfolio has an active buyback,
Okay.
and then you have the dividend carry on the long side. So, um, but we don't, like I said, we don't hedge with anything as in terms of ETFs or indexes. I feel like that's kind of a donation. Um, and, it is. I mean, it just it actually just kind of keep going up until they dart. But you're not going to be there on the short side if you think you're going to time that right.
Got it. I'm gonna throw a few names at you. Bank of California, BANC, which acquired PacWest, a huge problem bank from last year. AXOS Financial and Customers Bancorp, CUBI.
All right, so there's both all three have tug of war going on between guys that love him and guys that hate him. So
Mhm.
I'll give you that out there.
Which are you?
I'm not involved in all three of them.
Mhm.
Um, I think Bank California is going to be okay. I think Bank California actually is going to work for an investor. Problem with Bank California is there's just been so much heavy lifting over the last 7 or 8 years that the finish line is always kind of there. But seems like you're just swimming, swimming against the tide. Um, when that turns, I think Bank California does very well. Access is interesting. It's just kind of a different type of bank. It's uh, management has been proven very good, um, but there's a lot of skeptics there. So you know, and similar with what was the one?
Oh, QB, Customers Bank.
It's on customers, right? So customers, um, I mean, there's an inquiry there. Again, there's an investigation going on there. They just put up a huge quarter, ripped the shorts. Um,
Yep.
I've had great conversations with Sam, CEO. Um, the issue with Sam was he to go for his dad, and his dad's had some haters. Um, Rightfully so. He's made some mistakes. But uh, problem I have with like customers, um, and AXOS on, the regulatory environment, regulators live in a box, man. And they just, when you try to do something that's not in that box, the answer is usually no. And instead of the regulators really educating themselves and understanding that you have all the systems in place to do this and this is innovative, they just put roadblocks. So sometimes you're the victim of just the regulatory body that just doesn't understand it. And getting back to GBank, I think Ed and his team has done a fantastic job educating. The other thing about GBank is that, if you look at the board, I mean, the chairman, CEO, MD of hotels on the board. So there's a lot of people there with some influence to actually get in front of a regulator and talk about what these things, the PCS patents do. So, I mean, so when you get back to, the flip side of that, I just think that the regulatory environment sometimes isn't ready for the innovation that companies like CUBI figures out and AXOS figures out. Um, until that changes, there's always that risk that companies come under regulatory order or they have to go a different direction. So, and we've seen that, and it's painful for shareholders. And a lot of times it's not the company's fault.
And so, Brad, when it comes to what do you think is going to asset class is going to have the biggest trouble on a bank balance sheet going forward? Credit cards, is commercial real estate, residential mortgages, um, car loans, and then maybe I'm missing a small business loans. I'm missing a few things. But what do you think is going to be the biggest problem child? I guess both on an absolute basis as well as maybe you could say relative to expectations. So everyone's expect there's to be problems in commercial real estate loans. No one expects there's to be problems in residential mortgage loans. I mean, I don't. So I guess absolute as well as relative.
The resi, I think, is fine. Um,
Yeah.
I think residential is fine. First of all, I
Right.
have to run interest rate too, because I have a feeling that we could see interest rates come down and long rates just do nothing to go up. So that's what we've been concerned about. That's what you just saw. Um, so we're in an interest rate cutting cycle, and the 10-year reps from 385 to 470. So it's like, oh, okay. Um, so we have to kind of see that. We are not big on consumer.
Hmm.
Um, a lot of the reason why we're not big on consumer is the fintechs that got involved in it. So we believe the consumer non-recourse, non-guarantee loan is a ticking time bomb.
Is that
Uh,
include credit cards?
yeah. I mean, all that type of stuff. I mean, stuff from a firm, an upstart, stuff like that. And just what we can't quantify right now is that we know that that's going to be an issue. I mean, my opinion, I think that it's definitely an issue. What we don't know is, does that bleed into kind of stuff that the banks are doing? And when I mean the banks, I mean overall populace of the banks. Most of them are not subprime consumer lenders, um, or kind of weak consumer lenders. But as we saw in, some kind of subprime prices, it kind of bled through. So um, that's what we're paying attention to. Like I said, we were short a subprime auto lender.
Hmm.
That's done well for us.
Who is
You
that?
know, Credit Acceptance Corp.
Oh, yeah. Okay.
Um, and but a lot of this consumer stuff now is very predatory. Um, so eh, we kind of we just don't think that that's just a long-standing business. When guys get 8 or 9 problem revolving credits out there, and a firm's going to lend them, a loan at 36% interest rate. First of all, wish you could talk to that borrower and be like, listen, there's got to be a better way here, man, because you obviously don't understand interest rate math, but
Yeah.
can't take that loan out. Plus, if that's your business model, or we model like 8% or 10% losses, it's like, well, this job loss, economy gets a little bit softer. That'll be 20% or 30%, um, you know, non-performing loans. And just, I don't like companies that model for 10% losses.
I agree. I also don't like companies that the interest rates that they charge to customers are so high that they don't even report them to investors. You have to like do the math to figure it out.
No, I know. No, it's, yeah. I mean, so yeah, we don't think those are viable business models either, right? They can say it. One thing we've learned the easy way, and we've learned the forward way, and we've learned um, how to invest is in this type of stuff is if there's a fintech that's a credit extension fintech, right? So like a firm, someone that's actually lending money out. If management is from the financial background, they seem to do better than when they're from the tech background. The tech guys think that it is very easy. I'll agree with them. It's very easy to lend money. It's just hard to get it back.
Yeah, yeah, yeah.
So, um,
And I think finance people are aware that, they don't know anything about technology, but tech people think finance is easy.
Right. Oh yeah, no, lending's easy. It's like, oh yeah, we have this model. It's like, oh yeah, right. Like you could throw that out when there's clouds in the sky because those losses are 10x. Um, the other thing, they still run them like tech companies. I mean, a firm gives out, I don't know, six, seven, $800 million a year in gifted stock.
Mhm.
It's like, oh, okay, like in stock comp, um, like so they're just diluting themselves. I just so those are the problems. Like, I mean, banks are so cyclical that if you're not making money in good times, bad times usually get pretty ugly.
Right. So the low income consumer, subprime consumer, a lot of that is serviced by the non-bank lenders. You mentioned Upstart, Affirm, and the like. Uh, and then at the top end, you have American Express. American Express just reported, and their wealthy customers are spending a lot of money, and delinquencies and charge-offs are flat to down. So that is no problem. What about in that middle, in terms of credit card consumers who are, not ultra prime, but they're not subprime? Like I know Capital One just reported. I know that their delinquencies actually year over year are down. I think only 1 basis point, but like, do you think that that middle segment will be hit in terms of consumer credit as well?
Yeah, I mean, so I think that the Capital One Discover card deal is very interesting. I honestly don't know how that gets through and approved, but let's assume it does. I think that's kind of your middle market customer, right? I mean, that's it. Like those two companies came together, and that is one big. And as long as it's not a structural issue with Capital One, um, they should be your kind of bellwether to kind of see, what that middle market consumer does. Um, I again, if it's going to bleed through the subprime, you know, um, low credit score borrower, then it's definitely go through there.
Mhm.
Whether it goes through the whole thing, like I said, we'll find out. But I think you're already seeing charge offs, and credit tick up a little bit of Capital One. I think that continues. Um, Nothing that I feel is like dangerous. But I do think that listen, I think the consumer is hurting here. And yeah, Mark Express can say what they want, but that's people use that for travel. It's a big business credit card. Capital One is not. Discover Card is not. Um, so I do think this challenging environment to the consumer, less tax issue here. When this country gets better, and I don't really think that unemployment is going to get better. So, um, yeah, I think that there are some challenges here going forward.
Yeah, that is interesting, Brad. That unemployment is so low, and delinquencies are delinquencies are really high for such a low unemployment rate, right?
Yeah, because well, the bar was totally levered.
Yeah.
I mean, again, um, one thing that needs to change in this country is financial, education, as in terms of interest rate and kind of budgeting yourself and all that stuff. I mean, just the leverage that so people had two, three, four houses, and that's where the leverage was last time, and mortgage market blew up. The leverage on a consumer is beyond. Um, the amount of households living paycheck to paycheck is higher than we've ever seen. Um, and credit card balances high, savings are at the low, and balances are going up, right?
Mhm.
So we've gone through all of the funny money from COVID. That's kind of burned off. That masked 3 years of spending. Um, you know, it's just and it's interesting. Buddy of mine that's a investment guy in Australia said, probably your country is you guys don't like hangovers. Like you guys should take it right to rehab,
Yep.
So and he's right. He's right. So um the subprime consumer is gonna be um wearing it kind of coming forward here.
So why aren't you short Capital One or short more consumer lenders?
Well, we may take a look at them now that, there's been this kind of move for Trump, which he is going to be consumer friendly. He's going to be, you know, if his last 4 years he was there. biggest tax cuts were for kind of low income earners. So, that there's been this tailwind there. Um, and there's also this tailwind of interest rates coming lower. I'm just not quite sure how much lower they're going to come for that type of borrower, but it's kind of, we'll wait and see. Um, if we want to get involved in that, it's going to be, we have a strong feeling that credit's going to get a lot worse for these stocks to come down significantly. Um, Something we won't all be so concerned over that asset class, but um, credit trends have not shown us so far. Um, and so it's not a clear bet for us right now.
And do you think there's going to be a lot of IPOs this year? I mean, and especially given your background as an investment banker, 'cause I didn't know that.
Um, well, I was on the institutional side. And then I also worked with the investment bankers to kind of, you know, banks that have multiple needs, whether it's buybacks or research. So I kind of was conduit there.
Mhm.
Like helped out, kind of raising money, um, you know, through the institutional base. IPOs as in terms of bad banks, no. I mean, there are a few little conversions coming, but until we decide that we're going to, start issuing charters for banks again, which we haven't done in a decade. The charters will continue to consolidate. I do believe there'll be significant capital raises, and then the M&A should be, I think 2025's M&A, as long as interest rates kind of don't go crazy where it's hard to mark these balance sheets. I think M&A in 2025 will be um, more than the whole Biden administration over the last 4 years. The amount of mergers will be more than in the last 4 years.
For banks, and can you give me the line you said to me on the phone that 2025 for small banks will be the biggest M&A year in history?
Yes. Yeah, I believe that. I believe that. I believe the next 24 months, uh, the consolidation's there. Banks are willing sellers. There are good currencies. There are willing buyers out there, and regulatory and environment is not going to stop that. Um, and I think the small banks would be the biggest one. The other side is we have this phenomenon that credit unions are buying really small banks. They're not buying banks that most of the banks are under $1 billion in assets, but if a bank's, well, we had it last year. We had this First Northwest in Seattle. Stock was an 11 change. It was probably worth 18, 17 to a bank, and a credit union paid 23.50 cash. We're seeing 100% upside in some of these credit union deals. Why they do that, I don't know. Why they overpay and I don't know, but they don't have, they just can pay whatever they want. Um, they got to pay a little more because there is a little regulatory risk of getting it closed. Um, but I think that ship sailed. I think that most of these deals, unless there's an actual problem with that one deal, will close, and um, we'll reap the benefits of that. So, you know, um, we love Pennsylvania. We think Pennsylvania is going to be the hottest M&A state in the country over the next 24 months. Um, there's a lot of little banks that don't know what to do and can't earn their cost of capital, and they're paying out 7-8% dividends. So we think that state's going to be hot. Pennsylvania, New Jersey should be hot as well. There's a bunch of consolidation has to happen there. California and the Pacific Northwest, 3 more states that should be hot. Kind of the Southeast too. Um, you see population growth there. Banks doing really well there. You see asset growth should be a lot easier down there. Deposit growth should be a lot easier. And, you have some of these out of market banks trying to get into North Carolina, South Carolina, Georgia, Florida, and the means for them to do so. A lot of banks that they could have bought over the last 5 or 10 years are gone. So your targets are fairly, fairly slim in terms of how many there are.
So you really like small banks because of the mergers and acquisitions. Brad, thanks so much for coming on Monetary Matters. Uh, what do you leave your closing thoughts for the audience?
I mean, First of all, thank you for having me. Yeah, no, I think 2025 is going to be a interesting year, and I think that well, we saw a little bit of it already, but I think that if for the banks, if there's one more wave down in these fallbacks, um, and this fallback, it will probably become with the overall markets. Um, I think that could be a generational buying opportunity, and we've already, we did that in COVID. Um, when they busted in 22, kind of talked about that. The early 23 after they busted, we bought them there. Went on the S&P podcast and did that. So I think one more move down, and it could be a generational buying opportunity.
There we go. Brad, people can find you on Twitter at the Bank Zhar, ZHAR. I'm on Twitter, of course, at Jack Farley96. People can find Monetary Matters not just on YouTube, but on Apple Podcasts, Spotify, wherever they get their podcasts. Thanks again, Brad. Thanks everyone for listening.
Thank you.
Thank you. Just close the door.